Dear learners, welcome. This is our third lecture on the financial management. It is unit 14 of block 4 of your course TS3. In the first lecture, we discussed about the finance and what are the meaning, what is financial planning, what is financial management. In second lecture, we spoke about working capital management, cash management, motives of the cash. In this lecture, we will discuss about the cost, what is the meaning, what are types of various cost. Then we will discuss about budget, what is the concept of budget, what is the process of budgeting, what are various types of budget, and we will also understand budgetary control. So let us start with the cost. What is cost? Cost simply means the amount of expenditure incurred or attributable to a product or service. In simple words, cost is the amount of expenditure that we can attribute to a product or service. It depends on the context. Cost differs for the producer and the purchasers of the goods or service. Let us take an example. Suppose you are running or operating a travel agency and you prepare a tour package. You prepare the tour package with the hotel cost of around 50,000 rupees, the transport cost is around 20,000 rupees, and other miscellaneous costs are 30,000 rupees. So the total cost of this package to the business owner or for the business is 1 lakh rupees. Now you sell this package and the customer or the tourist, he purchases it for 1,20,000 rupees. So the cost is different. For the business owner, the cost of this package was 1 lakh rupees, and for the tourist, the cost of this package is 1,20,000 rupees. So this cost, it depends on the context, and basically it reflects the amount of expenditure incurred on the product or service. Means it was the amount of expenditure that was incurred by the travel agency. It was 1 lakh rupees. So the cost for the travel agency was 1 lakh rupees. And the expenditure incurred by the tourist, it was 1,20,000 rupees. So the cost for the tourist was 1,20,000 rupees. Now let us discuss about various types of cost. One is the direct cost. These are the costs that are readily identifiable with the product or service. Means these are the costs which we can identify with the product or service itself. Suppose we purchase a tour package. In the package there is hotel element, there is transport element, there is air tickets, there are train tickets, then there are guide services, then there are escorting services. So cost of all these elements which we can readily identify with that particular tour package, that becomes the direct cost. But this is not the only cost, because that package has been prepared by some staff and that staff is being paid some salary. That package has been prepared on some computer and that computer runs on electricity. There is some electricity cost as well. The staff was using some table and chair. The cost of those items was also there. So what about those costs? These are all the indirect cost. Means these are the costs which are not readily identifiable with the product or service. So direct cost in case of the package were basically the cost which were mentioned in the package inclusions. The services mentioned under the package inclusions, the cost related to those, they were the direct cost, and the costs that were not readily identifiable, they were the indirect cost, like the cost of the salary of the staff, the rent of the office, the cost of internet, the cost of electricity. These all were the indirect cost. Then there are some fixed costs. Means again the cost which does not change with the change in production. Then there are variable costs. These are the costs which change with the changes in production. So in the case of package or in the what were the fixed cost, the staff salary, the electricity bill, the rent, these were all the fixed cost. Means they doesn't change if there is production of one tour package or if there is a production of 100 tour packages. But variable cost, these are the costs which changes with the change in production. If you are producing or selling more packages, then there will be more variable costs, like the hotel cost will increase, transport cost will increase. So these are all the variable costs. Next is total cost. So what is total cost? Is simply the sum of fixed and variable cost. So when we add the fixed cost plus variable cost, it becomes the total cost. Next is opportunity cost. It is the cost of second best alternative. So suppose you want to go to Shimla and you were willing to spend 20,000 rupees. But at the last moment you decide that rather than going to Shimla, you will go to Manali and then you will spend 30,000 rupees. So the cost of the second best alternative, you were able to spend those 30,000 rupees because you were not spending the 20,000 rupees on your Shimla trip. So that is the opportunity cost for going to Manali. So that is the cost of second best alternative. Let us take another example. In case of campus placement, you get an offer from a company A which is offering you an yearly package of 5 lakh rupees. Then you got the offer from company B which is offering you the yearly package of 7 lakh rupees. So in order to join the company B, you need to leave the company A. So 5 lakh rupees is the opportunity cost to avail the opportunity of joining the company which is offering you the package of 7 lakh rupees. So that is basically the opportunity cost. Now the accounting cost. It simply refers to the monetary outlay for producing a good or service. Means the monetary outlay, how much money goes out of the organization or goes out of the books of accounts of the business or the firm or company for production of a particular good or service. That is basically the accounting cost. Economic cost, when we add the accounting cost and opportunity costs, it becomes the economic cost. Then there is sunk cost. There are some costs which once incurred they cannot be recovered. For example, the costs on the advertisements. Once you give an advertisement in the paper, you cannot recover that cost. There are some costs which you can recover. For example, if you start a business, you purchase some land, you purchase some machinery, and if you decide to wind up your business, you can sell the land, you can sell the machinery, and you can get some of the money back. But what about the advertisement? The cost that you have incurred on the advertisement, that is sunk cost. Even if you are winding up your business, you cannot recover the cost which you have already spent on the advertisements. So these are some types of costs. To understand direct and indirect costs in a better way, let us take an example. Let us take an example of a travel agency, and let us assume that the agency makes or sells 100 tour packages per year. Now again, we also assume that the average cost of accommodation, transport and other services that are mentioned in the package inclusions in each of the packages 50,000 rupees. So the direct cost per package arrives at 50,000 rupees. When we were talking about the direct cost, we have I defined the direct cost as the cost which are readily identifiable with the goods or services. So the items that are mentioned in the package inclusions, they are basically in the direct costs, and we have assumed that on an average the direct cost is around 50,000 rupees. Now let us take the indirect costs. Let us assume that there are 5 executives working in that travel agency and their total salary bill is 5,000 rupees a year. Now also let us assume that the yearly rent of the office is 2 lakh rupees, then the yearly electricity bill is 20,000 rupees, yearly internet bill is 10,000 rupees and other miscellaneous expenses are 20,000 rupees. So the total indirect costs, they come around 7 lakh and 50,000 rupees. But this is the total indirect cost and we need to calculate the indirect cost per package. So we divide this 7,50,000 rupees by 100 and we comes at the indirect cost per package at 7,500. Now what will be the total cost? We know that the total cost is direct cost plus indirect cost. Our direct cost for the package was 50,000 rupees plus 75,000 is the indirect cost. So the total cost per package arrives at 57,500 rupees. So with this example we can understand what are various direct and indirect costs specifically in case of a travel agency and tour packaging business. Now what is cost management? So cost management involves estimation and controlling of costs. First we need to estimate the cost, and then we need to control the cost. How we can control the cost? By increasing the production without any increase in the direct cost. So in the same example, if we increase the production, means if we want to increase the number of packages, then definitely the direct cost, that is the accommodation, transportation, guide services, they are going up, because they are the direct cost and they are the package inclusions that are directly associated with a package. But if we remain the indirect cost at same level, so let us, in the same example, let us take that there are 200 packages a year. So in that case, the average cost of the accommodation, transportation and other services per package, it remains the same, that is the 50,000 rupees. We have assumed it. Now the other indirect costs, that is 7,50,000 rupees, which were earlier divided by 100 rupees, now they will be divided by 200 rupees. So the indirect cost per package will be reduced to half, and it becomes 37,050 rupees. 3750, that is 3,750 rupees. So the total cost per package will be lesser, that is 53,750 rupees. So that is basically the cost management. What we have done, we have simply increased the production and we have not increased any indirect costs. Another important topic that we are going to discuss in this lecture is budget. Budget, this is the word with which we are very much familiar. We have heard it. We are preparing our household budget. We have heard that Government of India also presents a budget which is presented by the finance minister. So what is basically the budget? In case of a business, after raising the funds, the next important decision a financial manager has to take is the allocation of funds between current and long-term assets. See, in case of the business, the financial manager have to take various decisions. The first decision was with regard to raising the funds. How to raise the funds from internal or external sources. In case of external sources, what should be the ratio of debt and equity. Once the funds are raised, another important decision is how to allocate the funds between the current and long-term assets. So what is a budget? A budget is a systematic plan for utilization of manpower, material and monetary resources. Basically, it represents an estimate of future costs and revenues in quantifiable financial and monetary terms. So what is a budget? It is a systematic plan, means it is a plan for what? For the utilization of manpower, material and monetary resources. What are the aspects that we need to manage or we need to utilize? What we need to plan in a budget? These are the manpower, material and monetary resources. Also, it represents an estimate of future costs and revenues in quantifiable and financial or monetary terms. Budget also has some peculiar features. Some main features of budget are, it is always prepared in advance. See, in management we have discussed about what is planning. So planning is always about deciding in advance, and when we are planning about the future costs and revenues, then it becomes budget. So budget, it is always prepared in advance. Then budget is always related to some specific time period. Means this time period can be 15 days, it can be month, it can be 6 months, it can be 1 year, it can be 3 years, it can be 5 years. But budget is always related to some specific time period. Our government also had some 5-year plans. So what were they? They were also the budget, but the time period was 5 years. Our government also presents the yearly budget. So what is this? That is again the budget, but the time period is for 1 year. Next is, budget is always expressed in financial terms. Whenever we prepare a budget, it is always expressed in monetary and financial terms. We always speak in terms of money, receipts and payments. Next, budget is based on objectives to be attained, and it always needs approval from the competent authority. Means budget is always prepared for some specific objectives to be attained in future, and a budget is not finalized until it gets the approval from the competent authority. Means you prepare a budget, but until and unless the competent authority in your agency, or in case of the government, the minister or the officer concerned, they haven't given it the approval, it doesn't become the final budget. So budget is basically a type of plan, but what differentiates it from other plans is that it is about the money. It is about costs and revenues in future. What will be the costs in future? What will be our future revenues? How the future expenses will be met? How the future income will be earned? All these aspects, they are covered in the budget. So it is always future oriented. Now, what are the objectives of the budget? The first objective is to estimate income and expenses over the time period. Means whatever is the time period of the budget. If it can be, we have discussed that it can be from 15 days to 5 years or longer. So during the budgeted time period, what will be the income and what will be the expenses of the business? Next is to communicate the future strategy in actionable terms. Means what the business wants to acquire or what the business wants to achieve in future. That is reflected in the budget. Let us suppose there is a travel agency and they prepare the next year budget, in which it is decided that the sales will be increased by 20% and the profit will be increased by 30%. So this is the budget, and this is what is it conveying? It is conveying the future strategy, and that is also in the actionable terms, that the sales need to be increased by 10% and the profits need to be increased by 20%. Another objective is to assist the managerial decision making. Means the management takes the decision on the basis of the budget. Next is optimum utilization of available resources. See, when we were talking about the definition of budget, we told that it is about the utilization of manpower, monetary and other resources. So the another objective of the budget is the utilization of available resources in an optimum manner. Then further objective is it provides assistance in better control with easy comparison of budgeted, expected and actual results. Means in budget we make some expectations, like we want to increase our sales by 10%, then we can compare it with the actual results, whether we have achieved the objectives or not. So budget, it gives us the concrete idea about what we want to achieve and what we have achieved and what is the difference then in them, and how to negate or how to minimize that difference. Now the process, how to prepare the budget. The process to prepare the budget is known as budgeting. Like we know that how the process by which the budget is prepared, it is known as budgeting. It involves following steps. The first step is establishing objectives. Before preparing any budget, we need to establish some objectives. Now these objectives can be financial, that is in terms of profit or sales volume. The objective can be we need to increase the profit or we need to increase the sales volume by this much percent. So these are the financial objectives. Also the objectives can be non-financial, like improving reputation, being the lead organization, providing high quality services. Especially in case of the service organizations like tourism and hospitality organizations, along with the financial objectives, we can set some non-financial objectives also while preparing the budget. Like we want to improve the reputation of the travel agency or the hotel. We want to be the lead organization, okay, by providing the high quality services to our clients. So before we prepare the final budget, first of all we need to establish the objectives, and these can be financial as well as non-financial objectives. Second step is forecasting revenues. Revenues is basically the income, the business income. So during the tenure of the budget, what will be the business income? We make a forecast. For example, again in case of the travel agency, we can forecast. If it is an inbound travel agency, we made a forecast on the basis of past data that this is the number of tourists that we will be catering to this year, and this will be the level of income in the budgeted period. Once we forecast the revenues, then we estimate the expenses. Because the revenues, they are not realized in isolation. To get the revenues, we have to make some expenses also. So next step becomes estimating the expenses. In order to arrive the revenue figures, what will be the expenses that the business have to make? Why it was not done that we first estimate the expense and then we forecast the revenues? Because first of all we need to forecast the revenues, and in order to achieve those revenues the business or the firm or the organization need to make some expenses. So once we have the revenue forecast, then only we are able to make the expenses estimates, or we can forecast the expenses also. Once we have the objectives, we have the forecast with regard to revenues, we have the forecast with regard to expenses, then we go for the determination of the net income. So net income is nothing, it's simply revenues minus expenses. We reduce the expenses out of the revenues and then it becomes our net income. And in the last, we need to review, approve and communicate the budget to all concerned. Review means we revise all the previous steps, like we revise the objectives, we revise the revenue forecast, we revise the expense estimation, then we revise the net income. Once we know that all these things they have been properly revised, they have been fixed, then we take the approval from the competent authority. In case of a travel agency or private organization, it can be the higher management, that is the CEO or the MD or the chief financial officer, whatever is the competent authority, the approval is taken. And next process is to communicate the budget, like this budget is communicated to all the concerned persons. Next we will discuss about the types of budget. So on the basis of time, the budget can be short term, it can be interim budget, or it can be long term budget. Short term budget, it can be for 1 to 2 years. Generally the budget is prepared for 1 year, like our finance minister, each year they present the budget for 1 year. So that is basically the short term budget also. Then interim budget, it is for some specific time and purpose. For interim budget, let us take the example that the current government's tenure is ending in the month of October. So they will present the interim budget from March till October. That means it is for the specific time and purpose. So that particular budget is for some specific time till the new government takes the charge. So that is basically the interim budget. Also there can be long term budget, that is for 3 to 10 years. We have had our 5-year plans, that is basically the long term budget. Next is on the basis of flexibility. On the basis of flexibility also we can make the fixed budget that remains unchanged irrespective of the level of activity, and then there can be the flexible budget which can be changed as per change in the circumstances, and this kind of budget is preferable in case of tourism enterprises. See, in case of fixed budget, what are the costs generally covered? These are all the fixed costs which remains fixed. While dealing with the working capital also, we have discussed about the fixed working capital which does not change with the level of production or level of activity. So the fixed budget basically deals with those expenses and income of the business which doesn't change with the level of production or level of activity. So it remains unchanged. For example, in case of the travel agency, the example we have discussed, the budget for the salary remains fixed at least for the year. Then the next is the flexible budget. It can be changed as per the change in circumstances. For example, if the demand is higher, then we can change the budget, or the variable cost, they are generally factored in case of the flexible budget. On the basis of scope, there can be functional budget or there can be master budget. Functional budget means we divide separate functions and we make the budget for the each function. For example, there can be sales budget for the sales department, there can be production budget for the production department, there can be purchase budget for the purchase department, there can be separate marketing budget. Now that particular department's budget can be further divided, and then there we have the master budget. It is the sum total of all the functional budgets. If we combine all the functional budgets, then we arrive at the master budget. We can consider it like this. In case of a travel agency, the total expenditure, we have budgeted a total expenditure of 10 crore rupees in the next financial year. Means we prepared a budget for the next financial year, and it is assumed that the expenses they will be around 10 crore rupees. So that is basically the master budget. So out of those 10 crore rupees expenses, how much will be expense, how much expenses will be made by the sales department, how much expenses will be made by the marketing department, how much expenses will be made by the general administration department, that depends on the functional budget. So after budget, there is one important control technique, that is budgetary control. Budgetary control is simply the process of comparing the actual performance with the budgeted performance. See, what is budget? We have already discussed that it is a plan wherein that is future oriented, where we have make some expectations, make some estimations. Once those the time period lapses, then we compare the actual performance with the budgeted performance. For example, we have forecasted that the sales will be increased by 10%. After the budgeted time period is over, we compare the actual sales. So budgetary control is the process where we compare the actual performance with the budgeted performance. In case of variance in the actual performance as against the budgeted performance, then corrective measures are undertaken. See, if the actual performance is more than the budgeted performance, then that is a desirable condition, it's good. But it is not always. If in case of expenses, we have the budgeted expenses were lower and actual expenses are higher, then it is not a good condition. But in case of revenues, if the actual revenue collection is more than the budgeted revenue collection, then it is a good condition for the business. So what budgetary control is? It is simply comparing the actual performance with the budgeted performance. There are three types of ratios that we use in the budgetary control. First is the activity ratio. It is a measure of the activity attained over the period of time, and it is calculated as the standard hours of actual production divided by the budgeted hours. Then there is capacity ratio. It indicates to what extent budgeted hours of the actual activity are used and calculated as actual hours divided by the budgeted hours. Then the third is the efficiency ratio. It is a measure for degree of efficiency attained in production and obtained by the standard hours of actual production divided by the actual hours worked. See, in order to understand these three activity ratios, let us take an example. Let us assume that a factory produces 2 units in 1 standard hour. During an year, 34,000 units are produced and the budgeted production was 40,000 units. And actual hours of operation are 16,000. See, we have taken an example of a factory wherein 2 units are produced in 1 standard work hour. During an year, 34,000 units were actually produced and the budgeted production, means the forecast for the production, was 40,000 units. Actual hours that were worked during that year were 16,000. So standard hours of actual production, see, we know that 2 units are produced in 1 standard hour, and how much units are produced? 34,000. So standard hours of actual production should be 34,000 divided by 2, that is 17,000. Now let us calculate the three ratios. Now for the budgeted production of 40,000 units, the budgeted hours should be 40,000 divided by 2, that is 20,000 rupees, 20,000 hours. Now let us calculate the activity ratio. The activity ratio is calculated by standard hours of actual production divided by the budgeted hour. Now standard hours of actual production, we calculated that 34,000 divided by 2, that were the 17,000, and it is divided by the budgeted hours, that is 20,000, means 80%. It means this ratio specifies that as against the budgeted hours of 20,000, actual production was done only for the 17,000, means the activity was 85%. Next is the capacity ratio, means actual hours worked divided by the budgeted hours, and we have given that the actual hours operated are 60,000, and for the budgeted production of 40,000 units, the budgeted hours were 20,000. So the capacity ratio arrives at 80%. It means as against the budgeted hour of 20,000 hours, the factory worked only for the 16,000 hours. The capacity was 80% only. Then comes the efficiency ratio. It is the standard hours of actual production divided by the actual hours. So the standard hours of actual production were 17,000 and the actual hours worked are 16,000. So the efficiency ratio comes around at 100.6 hours. It means the efficiency was more. The 34,000 units which were to be produced in 17,000 hours, they were produced only in the 16,000 hours. It means the efficiency was good, but the activity and the capacity ratio, they were below par. The activity was only 85% and the capacity was only 80%. So this is, I hope this explains the budgetary control in more clear terms. In this lecture, we have discussed about the types of costs. We have discussed the direct cost and indirect cost. We have taken an example from a travel agency and we tried to define the direct and indirect costs. Then we have also discussed about what is budget and what is the process of preparing the budget, what are various types of budget, what is budgetary control, and what are the various ratios in budgetary control. Thanks a lot.